All right, folks, welcome to the video. Anthony Special here with Hawkeye Traders and Big Energy Profits. We're going to dive into an actual Big Energy Profits place trade utilizing the Hawkeye volume and price action methods, okay? So we're going to break down the thought process. I'm going to tell you how I dissected this setup and exactly how it all ultimately played out. So this is on Plug Power Incorporated, ticker PLUG, which trades on the NASDAQ, okay? This is a one-day chart, so a daily chart, meaning each candle or each rotation does display the entire day's session worth of price movement, meaning from the open at 9:30 a.m. until the 4 p.m. Eastern Standard Time close. So let's talk about it and focus on the price action that we're looking at right here. I want you guys to notice, and I'm going to zoom in just to make it a little easier for you guys to see. I know it's kind of big on my screen, but maybe not so much on your screen. I want you to notice these candles here, how there's a mixed bag of volume, right? So what does that tell me in the market? That tells me that there's a period of indecision. I got some selling volume, I got some buying volume, I have some neutral volume. I have a lot of indecision, a mixed bag, and basically the market has gone nowhere. Right, so that's telling me that buyers and sellers are trying to figure out who's ultimately going to gain control here. And then, whoever does gain control is likely who pushes either above or below this consolidative state that lasted 1, 2, 3, 4, 5, 6, 7 trading days, okay? So, after this consolidative state transpires, after we have a mixed bag of volume, ultimately we get what? Strong selling volume with a very aggressive candle to the downside. So that tells me that the sellers stepped in with aggression, all right? And there was price action to support the volume that was printed. So in doing just that, what are my expectations? My expectations are if price returns back to this area, we have now created an area of supply or resistance, whichever term you're most comfortable with. They essentially mean exactly the same thing. And that's what happened. We pulled back in, and guess what? We fell into 1, 2, 3, 4, 5 days, again, of mixed volume inside an area of confirmed supply based on this aggressive move out. So what are my anticipations? My anticipations are the sellers will step in to drive price lower once again. So the trade alert was issued here. So this was the closing candle on Friday the 13th, October 13, 2023. All right. So it went issued based on that day's settlement. So come Monday morning, the opportunity to get short was placed right here on Monday the 16th of October 2023. And I want to show you how this all played out. As predicted, based on the volume and price action, the market did exactly the same thing. It sold off aggressively right into my first target, okay? Now, I want to talk about the risk to reward ratio here as well, guys, because I can give you the best tools in the world. But if you don't understand risk management, there's no hope for you. And I'm sorry, I don't mean to be disrespectful, but it is in fact the truth that risk management must be your primary focus. And you're the greatest edge that you will have in the market, all right? Now, once you have that component in place, volume and price action are the only things that are going to be able to help you identify and execute trades with accuracy. So if my suggested entry is at 735 or higher, and I have a hard stop at 795, I'm risking exactly 8.2%, okay? That's the risk on the trade. If that's not comfortable for you, then this trade's obviously not for you, okay? I like to keep my risk at 10% or less, and you should never be trading with any more than 10% of your account size in any single position. So at the end of the day, this should not represent more than 1% of your entire account value, right? That means you could be wrong 100 times and still not have gone broke. So as the learning curve evolves, obviously your percentage of times that you are correct will become more and more frequent. So we're roughly an 8.2% risk with a initial take profit at 14 14.95%. Okay, it's just a little shy of a 2-to-1 risk reward ratio. Now, I employ this on every method in the market. Pay yourself, protect yourself. Okay? Never be too greedy to take profits. So, at 14.95%, we suggested now's a good time to take profit. And also a great time to take your stop and move it to your entry at break even, 735 or higher, wherever you entered the market. Now you are in essentially a free trade. You've liquidated a portion of your trade, you've covered a portion of your short, and now the balance of the trade, no matter what happens, you shouldn't be risking any more money unless in theory price gaps over your stop. That's a reality, and we're going to talk about gaps right now because the gap played a very essential role in maximizing massive profits on target number 2. So let's talk about target number 2. I'm going to dial this out a little bit. My calculated target number 2 was down here at $4.50, and that would have afforded us a 38.83% reward on our position. Now, the market decided to gap over that, okay? Now, if you understand how a gap plays, your order isn't filled until the session opens. So at the open of this candle down here, which was right there, we actually locked in 49.58%. Right? Because the order doesn't get filled where you have a limit order. The limit order isn't in play when the market's closed. So when a price gaps either below or above whatever your target may be, your order is going to get filled upon the opening price of that candle. So instead of getting 38% and change, we ended up getting 49.58%. Okay? So taking profit twice, just under 15%, just under 50%, and we still have a little bit left to go. Now, this trade's been running for a period of time, but guys, if you're taking, 50% wins, you can let it go. It's okay. You don't have to be so antsy about it, right? When if a trade's working for you, the worst thing you can do is choke it, right? You gotta let it go. Now, we've also, at this point, when this transpired, we moved our stop now to target number 1 at 625. So no matter what happens next, if price retraces back to our target 1 at 625, we just get stopped out with nearly 15% gain on the balance of our position. But if the trade keeps running in our favor, we have our last target down here at $2, which would afford us just short of a 73% gain on the short of this very inexpensive stock play. Okay? And this was executed live, right? This was all done through Big Energy Profits, employing the Hawkeye methodology. Right? I've taken the Hawkeye methodology, which I've mastered, right? And now I've applied it to day trading, swing trading, position trading. Because I understand the relationship between volume and price action, the time frame in which I apply it to no longer matters. The only thing that matters is that I do it consistently, I do it with discipline, and I employ extraordinary risk management tactics. For me, it's a method of paying and protecting myself. I am never too greedy to take money off the table when the market offers it to me. As you can see, we've come pretty close, but we have not filled our third objective. However, we have also not retraced back up here to target number 1 where we would be stopped out. So this trade is technically still in play. But massive profiting opportunities on a very low dollar stock were simply identified by going back to the origin of this trade, which was identifying indecision in the market based on volume. Indecision, aggressive selling. Retracement, indecision, in the same exact supply area we were in before. Execution, pay yourself, protect yourself. Guys, this is the only way, after 13 years experience in this business, to not only survive, but thrive. Comes down to an understanding from the technical aspect, volume, price action, right? From the money management aspect, risk management, right? Risk management should be the forward thought process in your trade plan. It is the greatest edge you can have in the market. Now, when it comes to the analysis component, there's nothing stronger, more reliable, and what leads the actual market than an interpretation and understanding of volume and price action. You pair those components together. Guys, you'll never win every trade. There is no holy grail, so let me take that off the table. But if you can combine those two pieces, the risk management aspect and the volume and price action aspect together, that is the recipe for success in this business. Now, of course, you have to be able to do it consistently, you have to be able to do it disciplined, and you must have the psychological, mindset to do those things. Not everybody does. Sometimes it takes a little training. It took me some training. It took me some studying, right? Because you have to think a little bit differently than how you think going to your 9-to-5 job. Trading the market is a business of probability. If you can employ your edge consistently, the probability becomes put in your favor. So guys, if you enjoyed this video, I ask you to like it. If you have a question, feel free to leave a comment. Below this video, I'm going to put some links. I'd like you to click on those links. I'd like you to consume the content. I'd like you to reach out to myself or my Hawkeye Concierge team. Ask whatever questions you may have and let us help you get to the next level in your trading business. Guys, I appreciate each and every one of you. I hope you learned something. God bless, and I will see you in the next video.